very much for.
If you could all be back here by 1500, please. It's 3 o'clock, and we'll continue then.
We are live on Capitol Hill this morning in the Rayburn House office building. A House Financial Services Subcommittee will be holding a hearing on the future of the Federal Reserve. On the first panel, 3 members of Congress will be offering their ideas for changing the Fed, and then we'll hear from several economists. Chairman of today's hearing is Texas Congressman Ron Paul. We believe that he is in the room, and we expect this hearing to get underway in just a moment. While we're waiting for this hearing to start, the law authorizing transportation programs expires at the end of next month. The House and the Senate have passed different versions of legislation to extending funding for the nation's roads, bridges, and mass transit programs. Today, members of the House and Senate Conference Committee will meet to try to reach an agreement on that legislation. That'll get underway at 3 p.m. Eastern. You'll be able to see it live here on C-SPAN 3. Again, waiting for the start of this hearing in the Rayburn office building, the House Financial Services Subcommittee, a hearing on the future of the Federal Reserve. Texas Congressman Ron Paul on your screen chairing this hearing of the Financial Services Subcommittee, talking about this or preparing to get this hearing underway on the Fed. He is the author of a book called End the Fed, and he's introduced legislation to do just that. Congressman Paul wanting a 1-year transition period to close the Federal Reserve, and after that, all of the Fed's liabilities and assets would be transferred to the Treasury Department.
This hearing will come to order. Without objection, all members' opening statements will be made a part of the record. The chair notes that some members may have additional questions for these two panels, which they may wish to submit in writing. Without objection, the hearing record will remain open for 30 days for members to submit written questions to these witnesses and to place their responses in the record. I also ask unanimous consent that those non-subcommittee members who are present be recognized if they wish to give opening statements or ask questions. I now recognize myself for 5 minutes for an opening statement. First, I want to thank our two colleagues for being here today, and they will be recognized shortly. But as many members know, that the subject of the Federal Reserve and monetary policy has been something that I've been interested in for a long time, believing that it has a great deal of significance, with regards to a healthy economy. Today we'll be discussing the various proposals to address the subject of some of the shortcomings of the monetary system. And I think what has happened here in these last 5 years, it has been recognized by many that monetary policy in the Federal Reserve has a lot to do with the creation of some of our problems and their shortcomings when it comes to solving these problems. The Federal Reserve has been around for almost 100 years next year, and of course it has gone generally under the radar. Not too many people talk precisely because it was always said that it should not be interfered with by the executive branch or the legislative branch. But lately there's been more concern. Last year, with the help of Congressman Frank, we were able to get some transparency of the Fed, and he was obviously quite helpful in moving that along. From my viewpoint, we still have more to do on that, but it's very clear whether we decide, exactly what constitutional money is and how it comes about. I don't think many people reject the idea that the Congress does have responsibility of oversight and figuring out exactly how to handle that. So with the crisis that came about in the last 5 years ago, I think an attitude changed dramatically. I think this is the reason that we had strong support in the last session for auditing the Fed, and more information has come out because of the lawsuits. But the way I see the monetary policy, and I think it's generally neglected, is most people realize how big the economy is, and they know about supply and demand of all products and goods and services and labor. But generally, they don't talk a whole lot about the other half of the equation, and that's the monetary issue. The monetary issue is 1/2 of all the transactions. So to duck the issue and pretend it's not important, I think has been a mistake. I personally believe that over these many decades, the Federal Reserve has gotten a free pass, because if we had good times, if they were able to stimulate the economy and have easy credit, and we had good times, they got the credit. Then if the predictable slumps would arrive and something had to be done, Congress would generally act, and the Federal Reserve would act, and they'd get the credit for getting us out of the slump. But I think that has changed in the last 5 years because of the seriousness of the crisis, how global it is, and how one of the consequences has been this excessive debt, and then the bailing out that occurred. So what the Congress did on the bailouts was significant but minor compared to how much the Federal Reserve was able to do. And for this reason, so many people want to know a lot more about what's going on. So not only do we want to know about policy, and a lot will be discussed today about the particular policies and how to guide that policy, but one thing we should not forget about is the nature of money. If we're trying to describe how we manage a monetary system, it seems to be most difficult, in my view, that you have to be able to define money and define the dollar, which has not been done for a long, long time. We use the Federal Reserve note as the unit of account, but there's no legal definition of a Federal Reserve note, and that's a pledge to pay something. So a note being something precise, and then you have to have management, and it doesn't work well, then we think, well, we just need more regulations and everything will work out smoothly. I have a lot of reservations about that because I think we have a lot of inflation. We have a lot of instability in prices. And even when the reports come out that the prices are rather stable, they seem to ignore the fact that the cost of living for many is going up significantly. The price of energy goes up, the price of medical care goes up, the price of education goes up. So even when the CPI and the PPI might not be revealing what's happening, there still is a lot of destruction of the value of money. And for this reason now, we've been in a decade or so where the real wages have not been able to keep up, which really is the bottom line, I believe. The unemployment factor and keeping up with the cost of living and keeping up with real wages. So I'm very pleased to have the various members today, as well as on the second panel, to discuss what I consider a very, very important issue. And now I would like to yield 5 minutes to Mr. Clay.
Thank you, Chairman Paul, and especially for holding this hearing on improving the Federal Reserve System and examining today 6 pieces of legislation to reform the Federal Reserve System. One piece to abolish the Federal Reserve, sponsored by our chairman, Mr. Paul, and another one that's sponsored by Mr. Kucinich, would make the Federal Reserve an arm of the Treasury. The other bills would make various changes either to the mandate or to the Federal Open Market Committee's governance. And as ranking member of this committee, I want to focus on the Federal Reserve's dual mandate of maintaining stable prices and full employment for monetary policy. The Full Employment and Balanced Growth Act of 1978, better known as the Humphrey-Hawkins Act, set 4 benchmarks for the economy: full employment, growth in production, price stability, and the balance of trade and budget. To monitor progress towards these goals, the Full Employment and Balanced Growth Act of 1978 mandated that the Board of Governors of the Federal Reserve present semi-annual reports to Congress on the state of the U.S. economy and the nation's financial welfare. The Humphrey-Hawkins charges the Federal Reserve with a dual mandate, both maintaining stable prices and full employment. Currently, the unemployment rate is 8.1%. Since President Obama took office in January of 2009, the unemployment rate has gone from 7.8% around inauguration to 10% as the impact of the financial crisis spread to 8.1% today. And I do believe that the U.S. economy is heading in the right direction. With the proper nudge, it could probably improve even more. As of March, the Consumer Price Index was 2.7% over the past year, a decline from February of this year of 2.9%. During the same period, the Energy Index has risen 4.6%, and the Food Index has increased 3.3%. Both increases are smaller than last month. In contrast, the year change in the index for all items, less food and energy, which was 2.2% in February, edged up to 2.3% in March. All of these factors play a very important role in getting America back to economic growth and prosperity. And I look forward to the witnesses' testimony. And, Mr. Chairman, I would yield back.
I thank the gentleman. Now I yield 5 minutes to Dr. Hayward.
Thank you, Mr. Chairman. It is with great pleasure that I anticipate the testimony from our distinguished colleagues. We have a great challenge before us because obviously a central bank our central bank, the Federal Reserve, we have cherished its independence in implementing monetary policy, and yet at the same time, obviously, the Congress has to establish monetary goals and hold the Federal Reserve responsible, and we have, obviously, as a Congress, the express power to coin money and regulate the value thereof. So there is this dynamic tension, obviously, between the independence of the Fed and its accountability to us. So it is going to be very interesting to hear your proposals as to how we make that, reach that balance. But in specific, with regard to the dual mandate, Chairman Bernanke has said many times that he does not perceive, in effect, he said he does not perceive an inherent conflict, if you will, in the dual mandate because, as I have understood him, serving the goal of price stability clearly works favorably toward having an economy that will work and that will enhance the employment prospects for all those who need work. And yet we see that his warning, which he has expressed very diplomatically regarding our fiscal policy having implications for monetary policy that it cannot overcome forever and ever by accommodation. We see that his warnings seem to be borne out in the fact that several years of accommodative monetary policy have not resulted in the kind of enhancement in our economic statistics that we'd like to see. So I look forward to your testimony and thank you for all the work that you have done on this very crucial topic. And I yield back, Chairman.
Mr. Chairman,
I thank the lady.
if I may, I'd like to ask unanimous consent that the gentleman from Minnesota, Mr. Allison, be allowed to sit with the subject.
We already asked for that unanimous consent, but without objection to make sure. Now, if the gentleman from Minnesota would like to make an opening statement, he could do that right now.
Thank you.
Very briefly, Mr. Chairman, thank you for your chance to make an opening statement and address this really important topic. I really don't have so much a statement as I have some questions that I'd like to just put out on the table for discussion, and I hope we hit them in the course of our afternoon. I guess my question is, the dual mandate, is it the problem? I mean, the fact is, to the degree that we've had challenges with monetary policy, has the dual mandate been responsible? If not, why the focus? I'm curious if anybody can point to an instance in the last 70, 80 years when the dual mandate requirement required the Fed to downplay their preferred anti-inflation approach to concern about unemployment. It seems to me that these are perfect. The dual mandate has been working. If it hasn't, I'd be curious to know when it has let us down and when the dual mandate has been the cause of flawed monetary policy. I'm also curious to know, how have we been doing with the dual mandate? Have we really been pursuing both and to the degree that the statute would call for? Has unemployment gotten the short shrift? I am concerned that we live in a time when we're getting used to an unemployment rate of about 8%. Might be all we can ever aspire to get down to. I think this is a national disgrace and an outrage, and I think our country needs to do much more to pursue both prongs of the dual mandate. I'm concerned that unemployment has not been getting its full due. And so these are some questions that I have, some concerns that I would like to see addressed. And even though I'm not on the subcommittee, I'm grateful to be allowed to be on it today and hope that we can explore these important topics. Thank you, Mr. Chair. I yield back.
I thank the gentleman. Now I yield time to Mr. Schweikert from Arizona for an opening statement.
Thank you, Mr. Chairman. I'll try to do this just very quickly. Since being placed on your committee, this has become actually an area of great interest. And one of the sides you're trying to get your head around, and as we walk through the pieces of legislation, is with what the Fed does in regards to monetary policy, has it, as part of its unintended or intended consequences, allowed those of us here in Congress to engage in really bad fiscal policy? In many ways, is it an institution through its actions that allows us to get away with bad acts. And secondly, even though this is a one-off, but in the discussions, the Fed is heading their holdings are what? Heading towards 2.9 trillion. What's the plan? At some point, when do they move back to normalization of their portfolio? And what is the potential cascade effects when moving back to a normalized portfolio? And with that, I yield back. Thank you, Mr. Chairman.
Thank the gentleman. Now I want to move to our first panel. First, I want to introduce Representative Kevin Brady from Texas as an 8-term Republican congressman representing the 8th District. He is the sponsor of H.R. 4180, the Sound Dollar Act. He's also the vice chairman of the Joint Economic Committee. Also with us today is the ranking member of the Financial Services Committee, Representative Barney Frank, is a 16-term Democratic congressman representing the 4th District of Massachusetts. He's the sponsor of H.R. 3428. I will now recognize Congressman Brady for his opening statement.
Well, thank you, Chairman Paul, Ranking Member Clay, members of the subcommittee. Before discussing the Sound Dollar Act, I'd like to acknowledge the work that Dr. Paul has done on this subcommittee as a long-time former member of the Joint Economic Committee to bring sound dollar to the forefront of the public debate. Inflation has been called many things: a hidden tax, a government-sponsored reduction in workers' paychecks, or, as Dr. Paul often says, theft. And more Americans understand the absurdity of a monetary policy that ultimately devalues our own currency. We agree on 3 key points. Preserving the value of the dollar is essential to economic growth and prosperity in America. The federal government must not be allowed to monetize its debt. And our financial system should serve the interests of all Americans, just not the interests of Washington and Wall Street. Again, I'd like to thank you, Chairman, for your steadfast commitment to bringing those issues to the forefront of the public debate. I'm pleased to testify on behalf of the Sound Dollar Act. I want to thank the members of this subcommittee who've already co-sponsored this important legislation: Mr. Jones, Mr. Lucas, Mr. Lukemeyer, Mr. Hazenga, and Mr. Garrett. The problem today is that, according to some, the 1800s was the British century, the 1900s was the American century, and the 2000s, 21st century, that may well be China's century. Well, not so fast. But for America to continue its preeminence in the global economy, it's important that we get the role of the Federal Reserve right. As we know, the Federal Reserve veered from the successful rules-based policies that brought the great moderation of the 1980s, 1990s, and instead adopted an interventionist approach that helped to inflate the unsustainable housing bubble and led ultimately to a global economic crisis during the last decade. This interventionist approach, justified by the employment half of the dual mandate, continues today, and I believe it's a contributing factor to this anemic recovery. The Federal Reserve's interventionist policies are felt by the single mom who goes to the grocery store, finds her paycheck doesn't go as far because inflation is robbing her of the value of her hard-earned dollar, and she finds the same thing as she fills her gas pump as well. These interventionist policies are also felt by the unemployed. The uncertainty generated by the Fed's unprecedented interventions is discouraging business investment in new buildings, equipment, and software, which drive job creation in America. If you look at the numbers, government spending is where it was before the recession. Consumer spending is where it was before the recession. Business investment is not, and the Fed has played a role in that. For America to remain the world's leading economy in the 21st century, Congress must give the Fed a single mandate for price stability, ensure that it is independent from political pressure, and hold it accountable for results. Critics charge that focusing on a sound dollar implies the Fed will ignore the unemployment needs of America. They're wrong. America can only maximize our real output and employment with long-term price stability. Protecting the purchasing power of the dollar over time provides the strongest foundation for lasting economic growth and job creation. Critics also react as if a single mandate is a shocking proposal. But as we know, the United States won World War II, enjoyed 3 decades of prosperity, and put a man on the moon without a dual mandate. It's not a fundamental part of our constitutional fabric. It's a 1977 policy directive based on the discredited Phillips curve, and Congress can change it. While it may be politically appealing, the current dual mandate asks the Fed to do something that it simply cannot do. Chairman Ben Bernanke has testified before the JEC that in the long run, the only thing the Fed can control is inflation. In the long run, low inflation is the best thing we can do for growth. And a Federal Open Markets Committee statement said basically the same thing. The maximum level of employment is largely determined by non-monetary factors. Further, using monetary policy as a short-term tool to speed growth may actually harm the economy in the long term. Let me skip to the end and make the point here that among other provisions in the Sound Dollar Act, we grant a permanent vote to all the regional Federal Reserve Bank presidents because as important as New York and Washington is, there is much more to America's economy, and the FOMC should better reflect our geographic diversity. We require the Fed for the first time to articulate its lender of last resort policy in order to reduce uncertainty and incidence of moral hazard. We speed the release of the transcripts from 5 to 3 years to create more timely information and transparency, and we make sure the new Consumer Financial Protection Bureau is accountable to hardworking Americans by funding it the same way as other agencies do during Congress. Mr. Chairman, I've included my full testimony for the record as well.
I thank the gentleman. Now, Mr. Frank is recognized.
Thank you, Mr. Chairman. I appreciate your acknowledgement of the work we did together. It actually is work, as you know, that began with one of your Texas colleagues, Mr. Gonzalez, who looks down at us, who was a pioneer in forcing the Federal Reserve to be open. He made them release information that they claimed didn't exist, a kind of a magical feat. But one of the things that ought to be noted, in every instance, beginning with Mr. Gonzalez, and maybe before I wasn't here, and the work we did, as the information flow has increased, it has been beneficial. There have been none of the negative effects some people have worried about. At the same time, it ought to be clear that the release of all this information has, I think, helped dispel the notion that there were nefarious things going on. We've gotten a lot of information out. Under the legislation we have, there will be no transactions the Federal Reserve engages in with private companies that won't at some point be made public. And I think that has reflected well on what they've done. And again, suggestions that there was something untoward going on haven't been proven true. Now, I filed legislation to remove the regional presidents from the voting power that they have. It was pointed out to me that that would have a problem of diminishing geographic representation. So I submitted an amended version that would have appointees to the board appointed by the President, confirmed by the Senate, from the various regions. The problem you have now is this. The regional federal bank presidents are picked by bankers. It is an extraordinary power that the FOMC has, as everyone agrees. And I cannot think of another element in American government where there is formal binding legal power given to the representatives of the industry that's in question. I don't think the American people are aware of the undemocratic nature of this, to have bankers who pick the regional president, who in turn picks boards, which are primarily from industry and with the financial industry dominant, and the statistics show that. To have them setting the policy seems to me gravely mistaken. So I think you can get to a presidential set of appointments without diminishing geographic diversity, and that's what we've done. Beyond that, I do feel somewhat compelled to come to the defense of the Bush administration. The single most important economic appointment made by President Bush was, of course, Chairman Bernanke. He'd been his economic advisor, chairman, and then he became head of the Fed. And frankly, I think people have been unfairly critical of Mr. Bernanke. He's obviously been reappointed and reconfirmed by the Senate. But once again, there have been predictions that haven't been borne out. The interventions by the Fed to deal with the problems that we had from the financial crisis have not led to inflation. Inflation is not at the point where it has become a serious problem for people. The loans that they've made, the interventions they've made, have actually made money for the federal government. They have not added to the deficit. And as I said, the openness shows they haven't caused problems in terms of any kind of conflicts of interest. Now, we did make some changes in the legislation that was passed. We mandated much more openness. We repealed that part of the law which said the Fed could give money whenever it thought it was important to do so, if they thought they might get paid back. And, of course, the best example of that was AIG. a unilateral intervention by the Federal Reserve in 2008, we still are owed some money. We've replaced that with some other ways to go. Finally, I think it would be a grave error to repeal the dual mandate. Yes, it is true that in the long run, monetary policy means what people have said. But as we know, the fact that something means something in the long run does not mean that that's the only run, that there are not times in the shorter run, in the intermediate run, when a balance is necessary. And I would say this, Mr. Chairman, I'd like to make a procedural point. I have a bill dealing with the presidents. I'd be content to see that put aside because I think we have a central issue here in the bill that my colleague from Texas has put forward. And let me say, I will agree with him on one point when he said that the dual mandate is not in the Constitution. I agree. Neither is the Federal Reserve. It was made up in about 1912. Wasn't in the Constitution. In fact, Alexander Hamilton tried to put it in there. He got his brains beat out a couple of times. But the question is this. There are very big differences, and to some extent they are partisan. And, you know, partisan differences can be carried too far, and they can become embittering. But they're also at the heart of democracy. It is entirely legitimate to have contending groups with different views. And there is clearly a major party difference in that those of us on the Democratic side think that unemployment is a very serious problem that deserves being addressed explicitly. And so I would urge you, Mr. Chairman, let's take the bill of the gentleman from Texas, let's put it out there. Let's have a committee markup, let's bring it out, and let's debate that one before the election. Let's not have it be a stealth present to the American people to take away the concern with employment after the election.
I thank the gentleman. I thank both members for their opening statements. I ask unanimous consent to include in the record written statements from the sponsors of legislation being considered by the subcommittee today. Without objection. I will now yield myself 5 minutes for questions. The first question I have is for Congressman Brady, and I love the title of your of your bill, the sound dollar. That's something I think is so important, but it seems to get a sound dollar, we need to have something we can define. Do you have a definition in order to give us an idea what our goals are, divorced maybe from the policy? How do we define the unit of account? Because it was precisely defined for a good many years. Matter of fact, up until 1971, in a relative way, it was always had a precise definition. So do you have in your own mind a definition for a sound dollar?
Well, I do. In my mind, we didn't include it in the legislation. Right now, the Fed has identified a 2% inflation, explicit inflation target, which seems reasonable over time. But truth of the matter is we want a rules-based inflation targeting. We want the Fed to stop the go-stop policies, the interventionist policies, and to focus on staying within the lines, both inflation and deflation. Your point, that is the strongest foundation for economic growth. Mr. Frank likes to point out that this is an either-or. It's not. The Fed does not do and cannot do a good job at job creation, as the chairman and their members agree. But over time, in fact, preserving the purchasing power of the dollar does create the strongest economy for the U.S., or at least the opportunity for it, strongest job creation. So no, there's not an explicit target in the bill itself.
So in a way, you define the dollar by achieving a price level or price stability.
We don't choose a strong dollar or a weak dollar, a sound one.
Because there are many free market economists who don't concentrate on that, and they, matter of fact, want a flexible pricing level, not a fixed pricing level. For instance, how would this have been interpreted, or how would the monetary policy have been altered, say, in the 1920s? Because a lot of people said, you know, there was no inflation because prices were stable, relatively stable, because productivity goes up. So if prices are relatively stable, and due to productivity, but then there still are distortions in the market, say in the stock market, that of course led to the 1930s. Can't you be deceived if you concentrate, on prices rather than looking at the total picture of the malinvestment. I know you did mention about not monetizing debt, but so how would you adjust for the fact that the price level doesn't give you the information? Because even today, a lot of prices, in spite of the monetary inflation, some prices are going down, like in electronics. At the same time, the price of an education, the cost of education skyrocket. So how would you adjust for that?
Thank you. One, I've long ago learned never discuss Fed history with you, Dr. Paul, since you're as knowledgeable as anyone on the planet that way. But looking a little closer in history, the last 40 years, what we saw in the 1970s, a great lesson. We were told we couldn't have a high unemployment and high inflation at the same time. Couldn't happen. As we know, not only did it, but the Fed's intervention, go, stop, actually created very volatile economy with very deep and frequent recessions. When the Fed focused back on a single mandate of price stability in 1979, that changed. And for almost 20 years, we had not only strong economic growth, but we had a very short, very shallow recession. So we saw the benefits of that focus on price stability. In 2000s, we saw the Fed keep interest rates too low for too long. It helped inflate a credit-fueled housing bubble, and helped create a global financial crisis. And to sort of wrap that up to your immediate question, within the Sound Dollar Act, not only do we focus on rules-based inflation targeting, but we require the Fed to monitor and report back on these potential asset bubbles, to monitor the price of gold, other commodities, equities, bonds, commercial real estate, agriculture, real estate, industrial real estate as well. And we don't force them to act on that because that circumstance will vary. But we want to ensure, to your point, that not just the price indexes of goods and services, but those potential asset bubbles not only be monitored, but reported to you and I and to the public as well.
I have a question for Mr. Frank, but I'm out of time, but I think there's going to be a second round, so hopefully I can get my question asked. I now yield to Mr. Gray.
Thank you so much, Mr. Chairman. Let me ask both witnesses. Currently, the unemployment rate, according to the Labor Department, is 8.1%. What can the Federal Reserve and Congress do to put Americans back to work? Mr. Brady, you have any thoughts or views on that?
I do. One, I think the Fed is trying to do too much. They're trying to make up for, I think, some failed economic policies, in my view, from the White House. And I also believe they're sort of like the doctor who gives you a pill every 5 minutes and says, how are you feeling? Take another one. How are you feeling? Take another one. As a result of actually creating uncertainty, I believe the more the Fed does, the less responsibility Congress and the White House is taking for getting the right fiscal decisions right, getting the right tax policy, getting balanced regulations, ensuring the right spending levels and entitlement reforms that actually create that uncertainty. So I really believe as the Fed does more, Congress is doing less, and in the long term, that slows our recovery.
Don't you think that Congress could be doing something now as far as passing a transportation bill, which would be a job starter?
Mr. Chair, Ranking Member Clay, I think it's important, especially long-term, to get our transportation policy right. I think that would be helpful. I also think taking off the table this discussion of higher taxes, just tsunami of regulation hitting these businesses. The President's health care plan, in my view, is a real deterrent to new job creation in America. So, yeah, there's a lot of things Congress can do right. And there's a reason the Fed said, in the end, we're not setting an employment target because in the end, we can't control employment.
Ms. Frank, what do you think the Federal Reserve and Congress could do to put Americans?
Do a great deal more. I think they have been very helpful and the policies that I think this Brady's bill would prohibit in the future, we would have been worse off if it hadn't been for them. I think the interventions the Fed has taken in two levels have been helpful to us. First of all, in helping to provide the funding that's helped our economy. Secondly, and I think this is a real point of difference between the parties, I was surprised by it. I think the role of the federal government, the Federal Reserve, in working with Europe, with work with the European Central Bank, has been helpful in avoiding the kind of serious downturn in Europe, which would have negative effects on us. I think the Federal Reserve's arrangements with the European...
Excuse me, check on your mic.
Thank you, Mr. Chairman. With the European Central Bank have been very helpful. And to have prevented the Federal Reserve from that kind of cooperation, increasing the chances of trouble in Europe, would have been, I think, a very grave error. Secondly, as far as Congress is concerned, we have the major activity. We should be following a two-step procedure. Long-term deficit reduction with some shorter-term stimulus. The fact is that the unemployment rate is higher than it would have been if we had not forced, by a variety of fiscal policies, state and local governments to fire 600,000 plus teachers and firefighters and public works employees and police officers. I think that's been a very grave error. They've been hurt because many of them are financed primarily by the property tax. Property values went down. I think forcing those reductions by inappropriate federal policy is a great mistake. And yes, it's important for us to reduce the deficit long term. Unlike many of my Republican colleagues who think the president wants to get out of Afghanistan too quickly, I think he wants to stay there too long. I think there is a great deal of room for reduction in the military budget. I think that we should be, and we'll be fighting about this in the budget. Do we cut the military or restrain the military, or do we cut our Medicare and Medicaid? So I would be for a short-term increase in spending and stimulus at the federal level here, including primarily to the states. You give money to the states, and they're going to hire some people who in turn will be spending some money. As for taxes, I heard the argument that higher taxes were going to kill the economy in '93 when I voted for the tax proposal put forward by President Clinton. And in the years afterwards, we had a very good economy. I don't have to claim that the higher taxes, marginal rate increase, a fairly small amount, caused that good economy. It clearly didn't interfere with it. I think if you talk about people are making more than $1 million a year, and for every $1,000 they make over that, you tax them for $56. It is inconceivable to me, and I think it has been proven by economic history, that it has no negative effect, and it allows us to do a long-term deficit reduction with some short-term help for the economy.
Thank you so much.
I yield 5 minutes to Mr. Schweikert from Arizona.
Mr. Chairman, would you like me to yield you a couple minutes to finish your previous question?
For me?
Would you like me to yield you a couple minutes to finish where you were at?
Thank you. Yes, absolutely. Thank you very much.
Mr. Chairman, I would rather be grilled by Mr. Schweikert than yourself, if that's okay.
No, I saved this one for the ranking member.
Okay. Okay. Go ahead.
You know, there's the big argument is, you know, dual mandate or one mandate. I'm sort of pretty much of a skeptic on what we get from the Fed, and I think they generally can find an excuse to do whatever they want to do. So I know that's an important argument, and it's going to go on for a while, but I'm not, you know, hopeful that in itself will solve the problem, because I think they're rather independent in what they do. But I wanted to ask you a question, Mr. Frank, about, you know, the appointees, whether they're approved by the Senate or not. Because a lot of people that I talk to are very interested in this subject. You know, they're very concerned about the fact that this isn't a government operation. This is a private operation, and they don't like the private. Now, do you think you fully answer that, or do you partially answer the question by saying people have to be approved by the Senate? Does this become less private and less sinister, or how would you rate that?
I wouldn't say necessarily. I wouldn't say sinister. I don't think the people on the Federal Reserve regional boards, who are predominantly from the financial industry in terms of influence, when they pick a president who in turn picks the new people, that's not sinister. They're people of goodwill, but it has an obvious bias. Yeah, I diminish the extent to which it's private sector by not having them vote. There's another thing we could do in that, Mr. Chairman. I know you were absent. Understandably, you have a couple other things on your mind. When we voted here during the reconciliation markup on whether or not to subject the Federal Reserve to the appropriations process, not monetary policy, but there was a proposal, as you know, to subject the Consumer Financial Protection Bureau to the appropriations process. It would seem to me another step that could be taken. I'm not for it myself, but for those who are worried, I would think consistency would say, why not subject the Federal Reserve, including the regional entities, to the appropriations process? So I think if you said that, now, there is an alternative in terms of the regional presidents, which would have them Senate confirmed. I think that might be worse. So yes, I think I diminish the private sector element.
Okay.
Another step for people who are concerned about it more than me would to subject them to appropriations.
I'm sorry, I don't want to use all of Congressman Schweikert's time. I yield back my time to David.
You weren't going to comment on the appropriations process, Mr. Chairman? I'm disappointed.
Tomorrow.
He's just sorry he wasn't here. Thank you, Mr. Chairman. One of the things I've been trying to get my head around is with the dual mandate, and this is for both our honored members here. Does it ultimately, do you think, because, okay, here we're chasing inflation, here we're chasing unemployment, but through the back door, does that also allow us as members of Congress often to avoid tough decisions, whether they be on, particularly on fiscal policy?
I don't see how it does. First of all, I reject the notion that we as elected officials should be blaming the Fed, or it's the Fed's fault. No, it's our fault if we don't step up. And to be honest, I don't think, in fairness to us, that we are avoiding those. The problem is we have very different views about how to do it. That's democracy. There is, some people want to raise taxes on the wealthy and restrain the military and make some domestic restraints. Others want to do others. I literally don't know anybody who doesn't have views on this. But no, I don't see the fact that there is a responsibility somewhere else in any way allows us to avoid anything. Our responsibility is the same.
Ranking Member Frank, you did say one truism, and that is ultimately it's our responsibility.
Yes.
And my 16 months here, I find policy-wise, we do lots of trying to push it off to regulators and others. You do the work, and that way we have sort of this plausible deniability.
By the way, let me just say, I think that is especially the case with regard to military activity. In my 32 years here, when I have seen us get involved in military activity without congressional authorization, it has not been so much executive overreach as congressional ducking.
Okay. I'm going to actually agree with you on that one.
The answer is yes, absolutely. As the Fed tries to do more, Congress, frankly, is using that in the White House as an excuse not to take the key steps necessary to create the business climate for recovery. If, in fact, the dual mandate is the right answer and the Fed is in charge of the economy, they're certainly not doing a good job. Weakest recovery since the Great Depression, lowest number of workers in the workforce. Despite the stimulus, the bailouts, auto bailout, housing bailout, stimulus 2, cash for clunkers, cash for caulkers, there's actually fewer Americans working today than when President Obama took office. At the end of the day, it's our responsibility.
Mr. Chairman, thank you for yielding back to me.
I thank the gentleman. Now I yield 5 minutes to Congresswoman Maloney from New York.
Thank you very much, and thank you for calling this hearing. I would like to ask Mr. Brady to respond to a statement from really Alan Blinder and Mark Zandi in their paper of 2010. They argued that the Federal Reserve's actions in the area of monetary policy during the economic crisis were more powerful and effective than anything that Congress did fiscally through the stimulus. And I would argue that the Fed's pursuit of the dual mandate contributed to avoiding an all-out economic collapse and helped fuel our economy. So I'd specifically like to ask my colleague, can you cite any example of how the dual mandate in any way hindered the recovery? Most economists believe that it was helpful in the recovery.
I think there are a couple key issues here. One, the Fed's actions in the mid-2000s, keeping interest rates too low for long, helped bring about the crisis that they later intervened in. Secondly, I do think...
But that happened during Greenspan's days.
We're talking the Fed as it is today and its actions over the last 4 decades, truly. Secondly, I think the Fed...
But we're discussing it just because I want to make sure you're answering the question.
Just
And on this point, if I could make it clear, what we're looking at now is the recovery, the actions that took place by Bernanke and others in response. And what would have, and you were saying the interest rates were too low, would keeping interest rates high to avoid inflation have been a sensible policy during the crisis when we were looking for recovery in 2008 and 2009. That's the time that we're looking at, how the dual mandate responded to the economic crisis, and I would argue that it was helpful. But my question specifically...
I actually wanted to give you a yes to your answer.
Oh, really?
During the financial crisis, even though the Fed, frankly, helped fuel it, some of their actions they took during the financial crisis truly did calm those waters. But stop there and look at the economic recovery since. In my view, pursuing the dual mandate, in some ways for the first time identifying it as a way to not only intervene, for example, in the housing market, and then continuing to intervene as well rather than allowing exiting that market, continuing to allocate credit around the United States, creating this uncertainty on what will the Fed do next has actually, in my view, hindered the recovery. So if you look at 3 points, did they help fuel the financial crisis? Yes. Were they helpful during it? Yes. From recovery on, in truth, no. In my view, we're not at the job levels we should be, in part because it's Congress's role to set the fiscal policy to create the business climate so recovery can occur.
Well, if the Fed had been constrained because they did not have the dual mandate in moderating inflation only, and would the recovery be what we are experiencing now? They were able to keep if all they had to do was look at inflation, they would have been raising interest rates. You know, they lowered them in 2008 and 9, which is very important because they had the dual mandate. And if they were constrained and to moderating only inflation, if that was the only thing they could have looked at, then they wouldn't have been lowering the rates. Having the dual mandate, most economists are arguing, gave them the flexibility to react quickly to the marketplace. I would also like to hear from the ranking member, Mr. Frank.
At some point, I would like to respond to that because I think I can shed a little light on it.
Well, first, I want to talk about the comment about the Fed's role in inflating things during the Greenspan years. I agree, but not by keeping interest rates in general down, but by explicitly refusing to follow the mandate this Congress gave the Federal Reserve in 1994 in the Homeowners Equity Protection Act. And in subsequent efforts, many of us did believe that loans were being made imprudently to people who couldn't pay them back. There were two ways to deal with that. One was, some argued, deflate the economy as a whole. I think that would have been a mistake. There was an option. It was to use the authority the Fed was given to ban imprudent loans to people who couldn't afford them. And Mr. Greenspan flatly refused to do that, later acknowledged that was an error in front of Mr. Waxman's committee. And then in that period, 2004 and 5, some of us on this committee, myself, Mr. Watt, Mr. Miller, tried to re-legislate that. So, yeah, I do think that there was a problem from the Fed, but it wasn't for not causing a deflation in the economy or less economic activity in general. It was refusing to use a specific tool they were given to stop the bad loans from being made.
My time has expired. Thank you.
I thank the gentlewoman. I now recognize Mr. Lugemeyer from Missouri for his 5 minutes.
Thank you, Mr. Chairman. Congressman Brady, thank you for your efforts on this Sound Dollar Act. I really like some of the things that you have in there. And I'm just kind of curious, do you believe that we need the Federal Reserve as a lender of last resort? Do we need a lender like that, some entity that can be the entity that puts the finger in the dike when something starts to happen?
The answer is yes, and it is your question in some regards addresses Ms. Maloney's question, which is under a single mandate focused on the purchasing power of the dollar, could the Fed intervene in times of emergency? The answer is absolutely yes. They would still be the lender of last resort, still provide liquidity to those banks, frankly, just have a liquidity problem, but are solvent. And of course, they have the ability to increase or decrease the interest rates to tighten or loosen the money supply. So they would still be, under a single mandate, have the ability to intervene in very unusual and exigent situations. What they would not be allowed to do is to continue to intervene far beyond that financial crisis, which again is contributing to the uncertainty today.
It would seem that looking at the last 20, 30 years, that their ability to impact our economy is greatly exaggerated on both ends. It would seem to me that they can nibble around the edges on these things, but if they actually had the ability to control unemployment, we wouldn't have the situation we have today. If they control inflation, I don't think that we would have had some of the situations we've had over the last several years. As long as you have an economy that's rolling along, very stable, it seems like they can tweak it around the edges, but it doesn't appear that they can do much more than that. So I really like your approach here. One of the questions that I had with regards to the section or Title IV of your bill with regards to exchange rate responsibility. Can you explain just a little bit about that section and why you put it in here and what you want to try and accomplish with that?
Well, is this dealing with the special drawing rights and ending that slush fund?
Yeah, exchange rate policy, renaming exchange to the Exchange Stabilization Fund.
You know, we have, unfortunately, over time, created, in effect, a slush fund within the Federal Reserve, both from historical, about $100 billion in there, half of that from historical dollars there, and the other half more recent. And unfortunately, Mr. Lukemeyer, what has happened is both Republican and Democrat administrations related to the Fed have used that, in effect, to circumvent the power of Congress. The Clinton administration used those dollars to provide a bailout to Mexico after Congress rejected it. The current Fed uses it to guarantee money market funds. Those may have been the appropriate efforts, but those decisions should have been made by Congress, not by the Federal Reserve. So under this bill, we end that as a slush fund. We apply the $50 billion to reduce the deficit. And we, in effect, return the Fed to what the Fed should do and retain for Congress our constitutional role to act in those matters of emergency.
So what you're trying to do is rein them in and go back to the established principles, our mission of what it originally should have been, and get it more in line with what most people think the Fed's mission should be.
Yes, sir.
Thank you. Congressman Frank, just quickly with regards to the bill that you've got, why do you believe it's important to have, I'm kind of curious, all of the Fed members be appointees versus are the Fed regional presidents going to replace those with appointees? Why is that? Why do you think that's important?
Well, first, can I just say one thing in response to your further previous question? The biggest power the Federal Reserve had to intervene freely was Section 13.3 of the Federal Reserve Act, which actually came from the early 30s under the Hoover administration, and we repealed that in the Financial Reform Bill. So they can no longer do what they did with AIG on an entity-by-entity basis. Secondly, the chairman asked me that I think it should be less privatized. Yeah. I understand the importance of geographical representation. I think we should have people who live in the regions be the appointees. But I can't think of a comparable case of formal governmental power, the right to set interest rates and the impact they can have on regulation, where the entity primarily concerned picks its own people.
Yeah, but you're assuming from your comment there that this is a government entity when it really is sort of a quasi-government and has a lot of private implications from its independence.
Everything.
Don't you think it should be more independent in its structure then as well?
Independence from the. I think you get